Soft day of trade as far as the benchmark indices are concerned. The Nifty ended the day with a cut of about 70 odd points, but the real red was seen on the Nifty Bank, which declined more than 350 points. Have a look at the intraday chart. We started well in the red and continued the decline towards the day end and ended at the low point of the day. This is the Nifty intraday chart that you're seeing on your screen. Moving to the Nifty Bank, that too actually saw some more weakness than the Nifty, which ended the day down about 380 points or 1.5% lower for the benchmark index. To give us his take on the markets and individual stocks and sectors, we are now joined by Mayuresh Joshi, Fund Manager at Angel Broking. Mayuresh, good afternoon and thanks for taking the time out and talking to Bloomberg Quint. First and foremost, your take on the markets, Nifty or the Nifty Bank. Do you have a trade over there?
So largely, again, I think the expectations in terms of how valuations were stacked up vis-a-vis how earnings are expected to come out. I think earnings were expected to be very soft in the aftermath of GST implementation. So largely, again, I think valuations looking quite reasonable and fair at this point of time unless the earnings start coming through. The banks have probably rallied a huge bit as well. So to that extent, numbers from the banking pack as well. A few of the larger private retail oriented banks have given excellent set of numbers as was expected from them. But the corporate facing private banks still have some sluggishness in terms of asset quality pressures getting reported on their balance sheet. And the same story continues for the PSU pack largely as asset quality recognition and stress in terms of slippages in credit cost still remaining high on their P&Ls. So I think the market correction, I think, or the consolidation, as I would put it, is long overdue. I think if the market does correct, that's a healthy sign because valuations probably looking fair at this point of time.
Sure. Mayuresh, there are plenty of earnings today. So we had IOC from the Nifty that reported a good set of numbers. IOC margins came in at 7.6% versus an estimate of about 6.5%. Did you get a chance to look at the numbers and what did you make of it?
No, so the numbers were much better than what analysts had pegged on the street. And largely, I think the play for IOC is going to be how their Paradeep refinery is functioning over the next few quarters with a complexity of 13 if it operates at a full utilization level over the next few quarters and years. I'm pretty sure that the GRMs are going to be on the upswing for IOC. Again, obviously, you have to reduce the impact of crude volatility. So inventory losses were a given for this quarter in terms of how crude behaved. But largely on a sum of parts, the marketing piece should also do very well for IOC with their pipeline network. The pipeline contribution to overall top line should be significant as well as the petchem volumes and realizations as well. So on a sum of total parts, I think it looks quite reasonably poised. Dividend yield is also reasonable at 4.5-5%. You can't ask for more on those aspects. The capex that they probably announced over the next 7 years and the operating cash flows of around 30,000 odd crores that it through every year. I think it's going to be very, very interesting because with new capex coming through, I think we'll be obviously able to improve the throughput as well as realizations on that count. Only what happens with the merger and the oil behemoth that one is talking about, I think that can create an overhang on the stock. But I think all the parameters should hold good for IOC over the next few years.
Sure. If I may, what will be your pecking order in the three OMCs?
So I think IOC, HPCL, BPCL, I think that's the way it goes.
Sure. The other big earnings that were announced today was Titan and Colgate, both of them posting results better than expected. Do you have you have a call over there?
So yes, I think as a consumption pack, I think both these stocks should do very well over the next few years. Colgate again has surprised in terms of both the kind of margin expansion that got exhibited in this quarter. And though I think the volume degrowth was given, the 5% degrowth in volumes was a tad bit better than what I had anticipated for the company. Going forward, I think as the restocking effect starts taking place and with them having a market share of 51% with promotional ad spends expected to remain high, and one really expects competition from Patanjali to persist, I think Colgate has created a different mode for itself in both toothbrushes and toothpastes. So in that sense itself, I think the earnings trajectory should improve with GST rates coming down. I think it's a matter of time that the pass-through will only improve volumes for the company. Similarly, in the case of Titan, the entire organized piece, specifically on the jewelry part of the business, is expected to do very, very well. As the reform measures have been taken by the government, both in terms of the demonetization drive, the introduction of PAN cards, I think the unorganized players are going to find it very, very difficult, specifically in terms of implementation of GST as well. So in that sense, I think the pie from the unorganized to the organized is going to benefit players like Titan. And again, I think the earnings trajectory should be on the higher side over the next few years. So yes, I think if I have a call to take on these consumption themes and baskets, these two stocks should do very well, but the investment horizon and profile has to be very long to probably get meaningful returns out of these stocks.
Sure. Mayuresh, there were two stocks in particular that I was watching out for. One was Reliance. It hit a lifetime high after a span of about 9 years. The other one was Bata. Yesterday evening, they reported the numbers, which also came ahead of street expectation. The stock gained more than 5%. Do you have a call on Reliance or any of the other footwear stocks?
So Reliance again, I think, has been an outperformer for this year, and the core businesses are doing exceedingly well. So petchem refining expected to do exceedingly well going forward as well. A large part of the capex on these two core businesses have been done with. So to that extent, the WIP gets converted into fixed assets, and as the sweating of these assets starts happening over the next few quarters, the operational cash flows can be quite substantial. On the GOPs, I think the capex that has already been done and the kind of capex that Mr. Ambani has earmarked. Again, I think the revenue recognition over the next few quarters is going to be extremely critical. The subscriber base that they've got, the new feature phone handset that they've probably come out with, which is much smarter compared to the existing feature phone handset. I think that's going to create huge disruption for the markets. ARPU is definitely better than the industry average at this point of time. And as expenses start getting accounted on the balance sheet as well, my own sense is that it's only a matter of time that Jio probably will start contributing on the EBITDA front as well. So yes, I think it will be some quarters away as it starts breaking even on that count. But largely, again, I think a large part of the recognition, both in terms of revenue and expenses, should probably soothe nerves, and the consolidated ROE should improve. Disclaimer, I think we hold this stock in our portfolio. For Bata specifically, I think the numbers have been a surprise this time around. So I think the kind of same-store growth that the company exhibited has been exemplary. Again, in terms of the top line growth, even if one assumes a 10-12% top line growth with the cost optimization and a very healthy balance sheet, if they're able to sustain and maintain margins around 11-12%, I think the earnings upgrade is a given for Bata. Again, I think the GST coming down for footwear below 500 rupees and Bata foraying into women's footwear, leather, accessories, so on and so forth, and with their own Coco style format stores exceeded to be 100 around over the next year. My own sense is that it's a matter of time that these footwear stocks get re-rated. So yes, I think Bata looks like a very promising thing. At the same time, I think one can actually keep a watch on Relaxo footwear as well. That stocks also looks very, very interesting because the earnings profile there has also improved drastically over the past few years. Debt equity of 0.2, you're looking at a compounded growth rate of top line of 14%, 22% on the EBITDA, 28% on the PAT. Even if they're able to sustain that over the next few years, I think even that stock is in due course of getting a re-rating.
Sure, Mayuresh. Last question. The metal pack was under pressure today. So we saw the likes of Jindal Steel losing more than 10%. Even Tata Steel was under pressure. Would you use this decline to buy some of these counters?
Again, numbers have been quite good and metals have again outperformed for the large part of last year. But again, it's a highly commoditized play. You're not really sure in terms of dynamics on the demand supply, specifically from a global perspective. Whatever reports we are probably reading, both on the ferrous and the non-ferrous part, I think they're very, very varied over a month, on a month-on-month basis. So having said that, I think I'll just wait and watch because the stocks have moved significantly. So I'll wait for significant corrections.
Sure. Thank you so much, Mayuresh, for taking the time out and speaking to Bloomberg Quint.
Thank you, sir.
We have come to the end of this segment of Market Wrap, but you continue to stay tuned into Bloomberg Quint, and for more stories, you can log on to bloombergquint.com. Thanks for tuning in.